We're a year into Donald Trump's second term, and investors really have no shortage of reasons to be nervous about holding US assets. Record fiscal deficits, concerned over the Federal Reserve's independence, and trade wars are also back on the agenda, most recently over Washington's fixation on Greenland. And against that backdrop, you might expect US Treasuries to be under serious pressure. But so far, that hasn't really happened. Volatility did flare up recently after the Greenland saga, which actually coincided with the sell-off in Japanese government bonds, pushing global yields sharply higher. US Treasury yields also followed northwards. But interestingly, the US dollar also dropped sharply. Even when Trump withdrew the tariff threat, the USD continued to slump. Now, this suggests that the wobble isn't just about foreign turmoil here. We're also seeing doubts creeping in about the US itself. I think it's important to keep perspective here. Despite the recent noise, the damage actually has been very limited. The 10-year Treasury yields are only marginally higher than they were in mid-January and may remain well below levels seen when President Trump returned to office. In fact, yields have actually fallen more in the US than any other major economy over the past year. In other words, bond markets are behaving themselves. In fact, the premium that investors demand to hold treasuries versus other government bonds has actually narrowed in recent months. So that really does make us question, why are investors still willing to give America the benefit of the doubt? I think the simple reason here is its relative attractiveness. Yes, the US fiscal position is definitely messy. There are concerns about US policy, but compared with the rest of the developed world, it actually looks surprisingly attractive. Japan, for example, is burdened by a huge debt. France is experiencing a slow-burning fiscal crisis, and Britain is stuck in low-growth, high-tax position. In contrast, the US economy is still expanding, its demographics are less worrying, and the dollar is still the reserve currency of the world. However, there is also another theory. Bonds often perform well when growth expectations soften. And while the US economy does remain resilient, growth has slowed, especially relative to what it may have been without tariffs, trade uncertainty, and tighter immigration policies. So if growth reaccelerates in 2026 as Trump's tax cuts take full effect, this theory will be put to the test. But then there's the final risks, and that is that the markets are actually underestimating the scale of change. So investors are comfortable with pricing in small shifts in inflation and growth. But Trump's agenda, from trade policy to the Fed's independence, this is extreme, making it far harder to model. So I think the warning here is if investors do change their mind, this time the adjustments could actually be swift and painful. For now, the US Treasuries remain remarkably calm, but beneath the surface, there is a balance between confidence and complacency, which is starting to shift, and that could keep pressure on the US dollar.